Ladies and gentlemen, good day and welcome to the Laxmi Rental Q2 FY26 earnings call hosted by Nuvama Wealth Management Limited. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions, and expectations of the company as on date of this call. The statements are not guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Ms. Ashita Jain from Nuvama Wealth. Thank you, and over to you, ma'am.
Thank you, Dennis, and good day, everyone. I, Ashita Jain, on behalf of Nuvama Wealth Management, welcome you all to the Q2 and H1 FY26 earnings conference call of Laxmi Rental Limited. From the management, we have with us today Mr. Rajesh Thakur, Chairperson and Whole-Time Director, Mr. Sabir Merchant, Managing Director and CEO, and Mr. Dharmesh Daptani, Chief Financial Officer. I now hand over the conference call to Mr. Rajesh Thakur for his opening remarks. Over to you, Rajesh, sir.
Thank you so much, Ashita, for the introduction. Good afternoon, everybody. A warm welcome to all of you, and thanks for joining our earnings call. On this call, we are joined by our MD and CEO, Sabir Merchant, CFO, Mr. Dharmesh Daptani, and Strategic Growth Advisors, our Investor Relation Advisors. The results and the presentations are uploaded on the stock exchange and company website. I hope everybody has had a chance to look at them. Following a good start to the year, we continue to deliver a robust performance in Q2 FY26, achieving our strongest ever quarterly sales for the second time in a row. During the quarter, we delivered revenue of rupees 72 crores, representing a 26.5% year-on-year growth. Such impressive revenue growth amid a volatile and uncertain global economic landscape highlights our business module's resilience. The effectiveness of our strategic approach, our commitment to operational excellence, and the deep industry expertise we have built over the years. In terms of margin profit profile, we maintain a healthy EBITDA margin of 15.3%, while the PAT margin stood at 11.8%. PBT, which is before taking into account the share of our JV profit, increased by 93.2% YOY. It is noteworthy that our healthy operating margin profile is despite the inclusion of scanner sales, which are strategic in nature and carry a relatively lower margin profile as compared to our core dental products. Interestingly, during the first half of FY26, we exceeded the number of scanners sold during the entire year of FY25. Notably, the margins were weighed down by around 90 PBS due to the impact of US tariffs. As a company, we remain deeply committed to advancing digital dentistry, use of AI in this field, enhancing brand visibility, expanding our dental network, and leveraging the growing opportunities within the dynamic dental industry. We are confident in maintaining our strong growth trajectory and meeting our full year revenue guidance while preserving a healthy margin profile, subject to ongoing global uncertainties. Now I will request Samir to give you some more color on our business performance during the quarter.
Thank you, Rajesh bhai. So during the quarter, we scaled new heights in both dental lab and aligner solution businesses. If you look at our product mix, excluding scanner performance for quarter 2 FY26, the dental laboratory business grew by a solid rate of 29.9% year-on-year, with a robust growth in both domestic and international markets. Domestic lab business grew by 23.2% and stood at 22.5 crore. This growth is primarily enabled by the scanners sold in the previous few quarters. This business will continue to grow at a fast clip with higher adoption of scanners amongst our dental network. Our international lab business grew faster than the domestic lab business, with a 39.2% year-on-year growth and stood at 18.5 crores. This growth is driven by an increase in business from existing dentists as well as addition of new customers and new geographies during the quarter. This growth is coming despite the uncertainty around the tariff situation in the US. To future-proof our business, we are targeting expansion of our client base across newer geographies. In Q2 FY26, aligner solution revenues rose by 12.3% on year-on-year basis to 20 crores. Within this, we have two parts: BizDent, which is the clear aligner business, and Vidya, which produces raw material and machine under the name of tagless, that is used for manufacturing aligners. BizDent is largely India-focused, whereas Vidya has a well-diversified global presence across multiple countries. As mentioned in the previous earnings call, we continue to witness some competitive pressure in the domestic market on a BizDent business. While we reported steady number on year-on-year basis, we were able to grow on a quarter-on-quarter basis. However, Vidya delivered a growth of 29.9%. This showcases the superior quality of materials and their growing demand and acceptance across the global markets. We were successfully able to add new customers as well as open up new geographies for tagless. In Q2 FY26, scanner sales grew by 94.7% on a year-on-year basis. This is in line with our strategy towards digital dentistry by targeting to increase our digital penetration to more than 90% of the dentists we work with. It's a win-win situation for all stakeholders as both the patient and the dentist get a good experience at the time of taking the impression, and also it brings efficiencies to the entire process while saving a lot of time as well as cost. Around 3% of revenue came from our other businesses, which we are intentionally scaling down some of these businesses which are typically low margin in nature. Now coming to our JV's performance, Kidri Dental, on a quarter-on-quarter basis, this business delivered a growth of 21.4%, reflecting continuous and gradual improvement in the business performance. However, the base of last year was on the higher side as we added new geographies and customers in that period. It is the nature of this business where we usually witness larger full kit orders in the initial phase of new customer addition, which then gets normalized in the form of repeat orders. From a long-term perspective, the company sees immense opportunities. In the global business, we continuously engage with DSO, large dental labs, chains of clinics to grow our business in the dental lab, tagless, and Kidri Dental. From a domestic perspective, we see a significant potential for growth led by higher digital penetration, driving sales for our dental lab and aligner solutions. There are several tailwinds like rising dental awareness, stricter regulatory norms, the importance of good quality products, and overall consolidation, which will give a further boost to the market. With continuous focus towards investment in automation and R&D, we at Laxmi Dental are setting a foundation for the next phase of growth. Thank you so much. I now would like to hand over to our CFO, Mr. Dharmesh Dastani, to take it forward.
Thank you so much. Allow me to walk you through our financial performance. Let me give a glance at our consolidated financial performance during Q2 FY26. Revenue from operations grew by 26.5% year-on-year, reaching rupees 72.3 crores, up from 57.1 crores in the same period last year. Gross profit for the year stood at 49.5 crores, reflecting 14.5% growth on a year-on-year basis. The contraction in GP margin is owing to revenue mix primarily driven by higher scanner sales. Employee costs, which are a major part of our overall expense, stood at rupees 25.8 crores as against rupees 20.5 crores in Q2 FY25. The increase was on account of annual increments as well as ESOP expenses amounting to rupees 1.7 crores. Our EBITDA for the quarter stood at rupees 11 crores, up 26.3% on a year-on-year basis, with margins at 15.3%. EBITDA margins for the quarter were impacted due to US tariffs, ESOP expenses, and annual salary increments. Our adjusted EBITDA, which includes recorded EBITDA, 60% of KIPSI Dental PAT, 49% of IDVG AIDN PAT, and ESOP expenses, stood at rupees 13.7 crore, reflecting a 25.7% year-on-year growth. Finance costs declined significantly as we paid off the entire amount of debt from our books. Our PAT for the quarter stood at 8.5 crore, which is an increase of 44.7% year-on-year from rupees 5.9 crore. Coming to our H1 FY26 performance. Revenue from operations stood at rupees 137.9 crore as against rupees 116.8 crore in the previous year, reporting a YOY growth of 18.1%. EBITDA for the period stood at 22.9 crore with an EBITDA margin of 16.6%. Adjusted EBITDA for the period was 28.4 crore. The company reported a PAT of rupees 16.9 crore and a PAT margin of 12.2%. We have done a capex of around 6 crore in H1 FY26. Our cash and bank balances, including fixed deposits, stood at 93.7 crore. Currently, the company has 64 crore of unutilized funds from the IPO proceeds, which will be deployed for a capex over the period of time. With this, we conclude our opening remarks and open the floor for Q&A. Thank you.
Thank you so much, sir. Ladies and gentlemen, we'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead, sir.
Thanks for the opportunity. Sir, just from the gross margin front first, with the scanner sales expected to continue in the subsequent quarters as well. So 68 to 70% is the kind of gross margin to look forward now?
Yeah, hi Tushar. So on that segment, again, it will depend on the mix of scanner versus our core dental business. If the mix remains currently what it is in Q2, then that should be the expectation. But we expect that along with scanner, we will grow the other businesses as well. So what we foresee is, say, midterm to long term, this mix should change and come back to originally where we were in the range of 75 to 80.
Probably that would be FY27 onwards because we expect subsequent second half also to have good scanner sales. Is that the right understanding?
For now, yes, we expect that. The scanner momentum is good in the current year, and also we expect it to stay reasonable in the next year as well.
And so just secondly on the international business, while you had US tariff impact, but the international lab business continues to be very strong. So just trying to understand that, like, is it that the realization has been impacted while the overall revenue has been there and hence the profitability for the quarter?
So the revenue is increasing primarily because not just on the US part, and like we said, we are exploring new geographies. We have added customers post our IDS event that we did in March in different geographies as well. So that is leading to the revenue. But again, yes, tariff is there. Currently in that situation, that is why profitability has been impacted there. But like I said, we are seeing a lot of news coming in every single day. In fact, yesterday there was a news from Trump that it should have an agreement very soon. So from a short-term perspective, we are, absorbing that because we do not want to get into a panic situation and, press that button for our customers who are long-term with us. But we see from a midterm to long term that this should not have an impact.
And so lastly, as far as guidance is concerned, we have 24-25% revenue growth. Does that stand intact for FY26? And also if you could, help us understand in terms of the margins considering this US tariff volatility for FY26. Thank you.
So I think what we mentioned during the start of the year that we are confident to do 20 to 25% revenue and between 13 to 15% PAT. Currently, of course, this all is, very fluid as it moves forward, but currently we are confident that we should be in that range.
So on the margin side,
13 to
given that we are at 15%?
Yeah, 13 to
EBITDA
15%
margin?
PAT. Yeah.
Okay. Thank you.
Thank you, sir. Our next question comes from the line of Ajay from Niveshaay. Please go ahead.
Am I audible?
Yes.
Thanks for the opportunity. Sir, my question is, because I'm fairly new to the company, I want to ask on the competition intensity. Sir, with this industry, dental lab industry, with only two large organized players, like one is us and then Dentcare in South. But what I have observed is several regional players, like from where I belong, in the Surat city. So players like Advanced Dental in the West, and maybe even a listed player like Vasa Denticity in North, scaling up aggressively through their acquisitions in the dental lab, like through Smile World. So my question is, how is Laxmi Dental positioning in itself to maintain its leadership edge? And what sort of structural or technological advantage do we have, like among these reasonable or smaller players, which maybe help us differentiate among themselves? And just to follow up on this, because given the rising competition intensity and what I understand the business model works is because is that the reason why we are aggressively pushing towards selling scanners, so that maybe that helps us getting more commitments from maybe the dentist, that helps us getting better utilization at our factories? So maybe you can maybe comprehensively answer that on the competition intensity and what strategies do we have to maybe, that would be really helpful.
I think on the competition side, while you look at the dental lab scenario, but again, we have always seen Laxmi Dental as a complete end-to-end integrated dental company. So in spite of whatever you said, we were able to grow by 23% the dental lab business. So yeah, competition is there in every category of business. To say that there is no competition in any business is just not reality. So what we feel is we are doing the right things, and the channel, like you mentioned, where we are focusing on digital dentistry is not just today. We started this almost 7 years back, with first time when we launched our service. And at the same time, that time itself, when we were the first people to bring in 30 scanners with 30 people of doing scanning, we have always thought that we should focus on competition which is within us, what we feel we can do the best. And in that regard, like we said, we've taken steps of digital dentistry, which is helping us. We have branded. We are India's only branded dental lab, if you see, where we sell our brand called Illusion Zirconia, whose brand ambassador is Madhuri Dixit. On the third side, we have great technology that we use, not just with the scanner, but the whole integration of scanners to the process and to the product delivery. And also together combined with that, our brand name. And it's important to remember that we are a 35-year-old company. Rajesh started this in 1989, which was formalized in 2024, but name of our chairman and Laxmi goes back that long. So that trust is very hard to build, on a short term with anyone. So combining all those USPs that we have, we are extremely positive that we will keep growing the dental lab business, and we will keep, being dynamic or whatever is needed, whether it's brand, whether it's digital dentistry, whether it's, hub and spoke model, to make sure that we always remain at a leadership position.
Got it, sir. Just a follow-up, because you mentioned that Laxmi's history goes long back. So, I just wanted to understand further on this, how do we plan to ensure the retention and exclusivity of clinics? As more and more labs adopt, maybe this digital workflows and maybe the competition increases. So, I wanted to understand more on how does the industry function. Is it like maybe a dentist when gets our scanners in their clinics? Is it like they prefer a single vendor who can maybe give them the crowns or the whatever the products we have for the lab? Is it like some exclusivity which we have, or is it like maybe one can maybe even consider through the regional players? So maybe more on how does the industry function, and in that given, how do we plan to ensure our retention and exclusivity of clinics? That will give better understanding.
Sure, that's a good question. Now, on the industry part and what we have been able to do and how we will do it in the future in terms of retention, I think we have a history of 35 years showing growth, showing retention. The number one feature where, you as a patient, if you go to a dentist, if you choose a dentist, you're choosing the dentist based on trust. Correct? You trust that if I go to this dentist, he's going to deliver me the right things. And that's the same thing for the dentist when they come to us. The first thing in their mind is the trust, that I trust this company, it's 35 years old, I trust it will give me a good quality, I trust it will give me a great service, and I trust in the brand itself. So those are the aspects from our side which we are, focusing. Apart from, of course, you can do a lot of other things, education, dental events, training programs, CDE programs, all of that is part and parcel of business. But this thing stands out that there are very few, like you said, who have this level of relationships of 35 years, this level of trust.
Understood, sir. That gives better understanding. And just one final question. On the scanner side, are we manufacturing these scanners, or are we like maybe part of our trading, like maybe which we are maybe getting it from outside and then just getting them deployed in the clinic? Just if you can clarify on this.
So currently, we have a private label agreement, which so scanners are manufactured based on our specs. But in the future, we are open to more models.
And because the scanners are because from what I have observed is the scanners are filled with Chinese scanners, and there are again some German and Korean. So and few of the import data which we are maybe able to gather. So there are even a lot of imports which are coming from Germany of the scanners. So wanted to know on our procurement, are we sourcing from which geography, if you can maybe help?
So that I think is a lot of information. With the question that you're asking, are you a dentist, dental technician? Are you running a dental company?
No, sir. Just that I've done some conversation with a lot of dentists around me to maybe understand, because the space is a lot attractive, and given how things are changing, I see the space which we are in a big opportunity underlies, and our focus on maybe international labs and the aligner segment and then the KIDSI. So overall we are very well placed. Just wanted to understand and get more clarity on the business front. Maybe the competition intensity and how does the business really function? So I've had a lot of conversations with few doctors, and that's why just confirming and getting more understanding on this.
No, that's good. Only thing I will simply say is anything that we do, we are always looking at vertical integration on the backward side. So backward integration, we have done it with our aligner business, we have with our pediatric business. And in the future, if we have to do it with any of our other businesses, whether it's scanners or other material business, we will do that where it will help us create more value for Laxmi Dental and their investors.
Understood, sir. I'll join back in queue. Thank you so much for giving detailed answering.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit the question to 2 questions per participant. Should you have a follow-up question, please rejoin the queue. Our next question comes from the line of Kamlesh Bagmal from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity. Sir, I had just one question on the cash flow. So in this quarter, if I see your payables, so you had paid roughly around 23 crore of payables in this first half. So say it has almost virtually come to 5 odd crore. So what has been the reason for paying for such a sharp reduction in trade payables?
Sure. I'll just hand over to Dharmesh, who is the CFO. He'll answer.
Yeah, hi. So the last year we had come out with the IPO, and there were certain payables relating to those IPO expenses, which were sitting in those trade payables account, which got cleared during the H1. So therefore, those are the payments related to those IPO expenses, and hence we are seeing a decline.
Okay. Got it. Thank you, sir. But lastly, what working capital days we are bringing, factoring in? Because I was of the assumption that these trade payables are more of part of your regular operations. So 23 crore of payment for the listing issues or listing or IPO related expenses, which seems to be too high, given the fact that we had hardly 140 crore of IPO.
Yes. So those close to 21 crores odd figures were pertaining to the IPO related expenses, and therefore you are seeing those declines.
Okay. And for our assumption, how much working capital days we can factor in?
Currently, it's in the range of about 65 days odd.
Great. Thanks a lot.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Devansh Tandon from Findoc. Please go ahead, sir.
Hi, thanks for the opportunity. My question is regarding the EBITDA margin, which is currently at 15.3%. I understand that it is mainly due to increase in scanner sales. But going ahead, are there any plans of increasing the margin, or is it possible that it can go to its previous size of around more than 20%?
So for us, that is where we intend, why we said about 20% margin. So currently, if you see on an H1 basis, we are 16.6% already. While the quarter is 15.3, H1 is 16.6. That is where typically H2 for us historically have been stronger than H1, subject to, of course, what the situation is happening globally. But then that is where we intend and we aim to deliver.
So is there any timeline by which you are targeting to achieve that margin?
If you ask us timeline, I would love to do it next quarter, but then we have to see how all the dynamics are. But on a, I would say, mid-term to long-term, that is for us a number which internally we are very confident about.
Okay. And my next question is regarding your ad spending. So it is visible that some of our peers in the aligner segment are spending aggressively on their ads. So we as a company...
Sorry, on which one your voice is cracking? Can you repeat please the question?
Yeah, sure. So my question is regarding the ad spend. Some of our peers are aggressively increasing their ad spend. So are we as a company planning to increase our brand visibility by spending more on our advertisements?
So now I think we are comfortable to what we are doing, and we have said that our spend on all the promotions combined is less than 5%, and that is where we intend to stay for now.
Okay, sure. Thank you.
Thank you, sir. Our next question comes from the line of Akash Shah from Investec Capital Services Limited. Please go ahead.
Hi, sir. Sir, just wanted your, your reiteration on the gross margin and EBITDA and PAT margin guidance for FY26, 27 and 28.
I think we on a perspective, it's very hard for us to tell you 26, 27, 28. But what you should see that as Laxmi Dental, we have said that 20% is at least the target, our first target, first benchmark to reach in terms of the EBITDA, and PAT margin for this year, we have already said 13 to 15%. So keeping that in mind, as an organization, as we keep exploring new geographies, domestic versus international expansion, branded versus technology play that we are doing, we hope that in the future we can give you more clarity on how this will move upwards.
Sure, sir. So, sir, in response to the question of an earlier participant, you said that this EBITDA margin guidance will be met in the mid to long term. So, is that correct? Is that understanding
Yes,
correct?
That's correct.
Oh, okay. Thank you, sir.
Thank you so much.
Thank you. Our next question comes from the line of Sarosh Setana from Redan Capital. Please go ahead.
Hi, good afternoon, sir. Can you hear me?
Yes, Sarosh, we can.
So I just wanted to get some sort of color as to, could you just cover what you do in the pediatric space and where you're aiming for that sector to be at in a couple years' time?
Sure. So on the pediatric side, Sarosh, I would define us as a full-fledged pediatric solutions company, whether it's the crown that a kid needs from teeth crowns, zirconia crowns, bioflex or flexible polymer crowns to MTA putty to space maintainers to silver diamond fluoride. So there are a lot of products that we have in that range. And if you ask us what our vision for that company in the future, like it is for whole of Laxmi Dental, is to be truly international company which is working in, I would say, every country on the planet where we can sell the product. Currently we are confident and we feel that our product range is such that we can sell in every country on the planet, provided we do the right amount of BD to reach the country and we get the regulatory clearance to sell in that country. So that's a similar vision across all our businesses.
Okay. And from a revenue breakdown point of view, what is the goal for this sector to eventually be at?
Again, on the revenue side, more than that, I would say on the growth side, like we have said in the past, 20-25% growth for this year. And like I said, as we come closer, we will keep giving you more updates on the holistic business. On the individual business, there are different milestones internally that we have, but we would always like to focus from an investor perspective to give business which is more holistic than individual.
Okay, thank you. I'll come back into the queue.
Thank you, sir. Our next question comes from the line of Ravi George from Prajini Financial Services. Please go ahead.
Hi, good afternoon. This is Praveen here from Prajini Financial Services. Congratulations on the strong top-line momentum this quarter. So I had a few questions to understand the underlying trends. So my first question is on the Kids Dental segment. So do you have any R&D or CapEx that is planned in this segment? And Kids Dental seems to be getting back on track. Like, are the international regulatory approvals and export registrations moving as per plan?
Great. Thanks. Firstly, thank you so much for congratulating us. We appreciate that. Number two, on the kids side, yes, you're right. We have seen good growth quarter on quarter, and the regulatory clearance in different countries is moving as per plan. So we can expect once we get those clearances, this will move stronger.
And can you talk about the R&D expense that you have planned?
So R&D expense is not major, I would say. We have an R&D team, we are doing R&D, but it's reasonably in control.
Fine, sure. So I have one more question. So on the aligner side, the B2B2C segment seems to have stabilized after facing competition earlier. Now, what changes have you made in pricing, branding, or channel strategy? Have you offered any kind of discounts to regain momentum?
So I Don't think that is the strategy. The reason, if you see, we have been able to, in fact, improve our margins from what we were last quarter to this quarter in business, which is the line of business from 6.8 to 15.8%. That's the primary reason that we are not going on that path. We are trying to focus and see the best part which we explain the investors who are with us, that we are a end-to-end integrated company. So when we see certain scenarios which on a short-term basis could have an impact, we are always focusing on the margin part, and then we will make sure the growth is on the other segments. And similarly, because every segment, every business goes through this process. And that is exactly what we feel in our mind, that currently, if the aligner segment is doing this, we actually on quarter are growing. So it's not that we are not growing. We are growing the top line, we are improving the margin, and that is how we see it forward, that we will always remain focused on growing the top line along with the bottom line. At no point in time, we intend to really overspend on what we are doing to just have the top line.
I have one question. You have this large scanner set that you've built, right? So how are you planning to use data network advantages? Could there be a software or subscription component or something like that over time?
Yeah, there could be many things. Once you are in technology, it's like you said, building technology, deploying the hardware, deploying all the necessary software to make sure it works seamlessly is a very tough thing to do, which is what we're doing right now. But when we have that base, currently if the base is 1,000, 1,012, 1,200, 1,500, once this base becomes in the next couple of years 5,000, then all the efficiencies of scale, the efficiencies of subscription model, the software model, a lot of things will open up for us. And that is why, this strategy has been so important for us since last couple of years, that this will give results in the next midterm to, long term, where the company and the investors will really see the difference that we are creating.
Thank you. Thank you so much, sir. Clear. Thank you so much.
Thank you.
Thank you, sir. Our next question comes from the line of Ashita Jain. Please go ahead, ma'am.
Yeah, thank you. So we have one question on this aligner business. You mentioned the competitive intensity is high in this business. Could you please elaborate on this, and how are we positioning ourselves in this space, and what is our strategy going forward in this segment?
Okay, hi Ashita. So on the aligner business, like I said, our positioning in the past, we being the branded player, we having the trust factor. So the positioning is very similar, that we will keep our brand in terms of trust is the number one component, that when someone prescribes illusion aligner as a dentist, they have to be assured of the result. But at the same time, we are expanding the product portfolio, like we have introduced teen aligners, which was not part of our portfolio. It has just started. We have introduced POT, which is pre-early orthodontic trainers for pediatric patients. So we are expanding the product range, at the same time increasing the penetration amongst existing dentists who are already with Illusion Dental Lab, and increasing our portfolio to different kinds of dentists, like not just the orthodontist, but the general dentist as well as the pediatric dentist. So that on a mid to long term will make sure that we are constantly growing, since we are not just expanding in geography, but we are also expanding the dentist network in terms of the type of dentist, orthodontist, general dentist, pediatric dentist, and also the range of products that we are expanding.
And any comment on the competitive intensity?
I mean, it's there, one of the person previously mentioned that this is like a go-to category for a lot of people. So yeah, there are people who are coming in, smaller startups, doing some things, aggressive discounting, but all in the end, it's going to be survival of the fittest, and we are extremely fit in terms of our book, if you see. As a company, we are solid in terms of growth, we are solid in terms of EBITDA, we have great PAT. So all in all, if we have to weather the storm for a couple more quarters, we'll weather it. But eventually, everyone will fizzle out, and there may be a few players left, and then the growth exponentially will start again. In spite of that, but if you see, we are still growing quarter on quarter. So it's not that we are not growing, we are still growing. But it's just that we are pacing our growth in a way not to burn too much.
Understood. And just on this Kids Dental, you mentioned that the country registrations are going well, but when do you expect the historical growth rate of 25-30% to come back in this business and country registrations to be over for the Kids Dental?
So I feel that based on the feedback that we have had from our regulatory team, Q4 is when we expect to get the CE, which is an important step. CE opens up almost close to 40 countries for us in the world. And then the next step is going to be MDSAT. So once CE opens up, I think we should go back to the numbers that we were in the past in terms of growth.
Understood. And just lastly on this lab business margin, if we see for the last 2 quarters, we were in the range of 20% plus. Now for this quarter, it's 15%. While you mentioned about the tariff impact and increment as well, but anything else to highlight, and how should we see these margins now moving in the coming quarters?
So see, operation efficiency will drive as we'll get more geographies, more customers. This will drive the efficiency. Two, again, tariff is there. If tariff goes away, this straight away goes up. So, we just have to wait and watch of how the global scenario pans out.
Understood. That's it from my side. Thank you.
Thank you so much, Ashika.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Smith Gala from RSPN Ventures. Please go ahead.
Yeah, thank you for the opportunity. I just wanted to understand the scanner sales that we are doing in a bit more detail. Firstly, wanted to understand what kind of benefit the scanner actually provides. I understand that we are selling the scanners at lower cost, but it gives us a benefit of increased sales in the future. And for the dentist, it gives them more accuracy. So what was the mistake rate or the error rate in the past with the scanner sales is solving?
So, Smith, thank you for your question. We usually look at it in a more holistic way, that when a dentist adopts a scanner and when we sell a scanner, there are 2 different parts. Correct? So let's go to the dentist first. They are most important here as customers. When a dentist adopts a scanner, it is not just that the remake rate or the error rate goes down. Of course, that is absolutely understood that once we move to digital technology, it's going to be better than the physical technology that they are using. But at the same time, the turnaround time, where say a physical impression from anywhere in the country, if they want to send it to Mumbai or even say within Mumbai, it's going to take them, morning session to evening session, 6, 8, 10 hours. Any other city, it takes 24 hours. But with a digital scan, it's going to take them 2 minutes. That's one part. Number 2 for them is tremendous patient comfort. I don't know, Smith, if you or someone in the family would have made a crown or a cap and you had that, silicone thing getting in your mouth and staying there for 3 minutes for it to set and remove. It's not the most comfortable feeling that you have. Correct?
True, yeah.
Yeah. So that feeling completely goes away. So the scanner moves, a dentist who starts previously, maybe say within the first month or within the first 3 months, he can take a scan like in 30 seconds. So it just moves around in 30 seconds in your mouth and the scan is done. So that comfort is absolutely amazing for a patient. Number 3, the OPEX versus CAPEX for a dentist. Now when a dentist makes an impression, it could range from 300 to 700 or maybe up to 1000, depends upon what kind of materials they are using and what kind of product that they are giving in your mouth. But when they use a scanner, it's a capital cost. The scanner doesn't have any operation cost. You can just scan. What is using is just electricity on a laptop. That's it. So that way, the dentist has tremendous efficiencies as compared to CAPEX and OPEX. So there is no inventory that he needs to maintain. Number 4 is when they send a scan versus an impression. Now you imagine, I'm sure everyone who is on the call here would have had to go to a dentist. When the dentist calls and says, "Hey, आपका impression है माप थोड़ा बरोबर नहीं है, you'll have to come back again. I have to do it again." Because the physical impression goes to a dental lab, the dental lab will turn the negative replica, which is an impression, to a positive replica, which is a plaster model. And then we identify, oops, there is a little bit of an issue. And then the dentist calls you back. Versus digital, we have a service which we really focus on and we are really pushing a lot of tech in that. It's called LVL, which is live scan verification. So live scan verification does when a dentist scans, currently it takes about 3 to 5 minutes based on the internet bandwidth for a dentist to enter that scan. We open that scan and we can give him live feedback within 5 minutes. So that is like good. You don't have to go back. You are okay to wait 10 more minutes versus going back to a dentist. So that is one of the key factors where the patient visits are reduced. So on the dentist side, these are all great parameters which why they want to invest in digital dentistry. And from the lab side to us, we don't need a physical shipment, so we are saving logistics. We don't need to convert a physical impression to a plaster model and then convert it to digital. So that's less steps, less people in the system. We don't need to wait for a dentist or for us to call them saying, oops, there is a problem in this impression, can you make a new impression? So we are spending twice on logistics for the same impression. Versus when they send digital, we can answer them right away. And then once it comes digital, our efficiency in the lab also improves. So all in all, this is a tremendous win-win for this. If you study more, I would request anyone who wants to do this, study more online about how developed countries in US and Europe have done this, and they have been super successful.
Okay. And one quick question, the 13 to 15% PAT margins which you guided is including the tariff impact or excluding the same?
Sorry, can you repeat that? I missed it.
The 13 to 15% PAT margins which you have guided for FY26 is including the tariff impact or excluding the same?
So right now, if you see our H1, we are at 12.2.
Yeah.
So, we in our mind, we feel we can still do it between 13 to 15%, even at the current scenario. But like I said, we have to see if 50 becomes 10 or 50 becomes 100. Nobody knows. You don't know. I don't know what happens. But for now, if we are at 12.2, we are healthy, and we said that H2 is always stronger than H1.
Okay. Thank you. All the best for the future.
Thank you.
Thank you. Our next question comes from the line of V. Rajesh Vatera from Nivashare. Please go ahead.
Yeah. Hello. Am I audible?
Yes, Rajesh, you are.
Yeah. So my first question was earlier we used to take minimum work commitments from dentists while deploying our scanners. Since scanners are high ticket investment and smaller clinics usually avoid such cases, so are we still following the same commitment based model or has this structure evolved as scanner penetration has increased? And my second question was regarding media solutions. Under media solutions, we manufacture raw materials for aligner and our related dental products. So considering players like Privest Denpro makes margins of 35% EBITDA, and in the same raw material manufacturing business, so how would we see margin potential of media solution, particularly at that segment?
Great. So I'll go to the first question where you said on the scanner model. Now the scanner has two models. Like you said, not every dentist will be able to afford it today, but eventually, in the next, I would say 5 years, majority would have it like an X-ray. In the past they had physical X-ray. Now a lot of dentists, I would say majority percentage have digital X-ray. Similarly, we see that the scanner industry will pan out that way. And that is the precise reason the model 1 is with minimum commitment. The model 2 is we give scan as a service. So we have our salespeople who have a scanner with them, and by appointment, they go to a dentist, and along with the help of the dentist, they can do a scan. For that, the dentist, has to pay a very small fee, which is, similar or lesser than what they would spend on an impression. So those two models are hybrid because what that does is, when we give scan as a service, it opens up them for utilizing the scanner, using the scanner, and two, creates a sales funnel for us because we precisely know that X number of dentists are calling us maybe 5 times a month, or some of them are calling us 15 times a month. So when we see that traction moving upwards is when we go back to the dentist in terms of setting the scanner. Now coming to your question 2 on the media part, already if you see on the Q2, we are at close to 24%, 23.6%. And we see today we are still investing in terms of BD, in terms of marketing, in terms of R&D to create our profile of products. In terms of regulatory clearances, where we want to move to 150 countries in the world. Once we are on a stabilized position, I think this is a good business where it can see margin upwards of close to 30% in the future.
Okay. Under Varia, as per my knowledge, we are manufacturing some thermoforming machines. So are we also selling that machine?
Yes, we are.
So that is also like scanner, the trading part, or these are manufactured by us?
No, it's manufactured by us. We manufacture it ourselves.
Okay. Thank you.
Thank you.
Thank you so much. All right. So our next questions come from the line of Ajay from Nivash. As a follow-up question, please go ahead.
Hello.
Yeah, hi Ajay, we can hear you.
No, I guess I'm done with my question. Thanks for the opportunity.
Excellent. No problem. Thank you so much.
Thank you so much. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you. With this, I conclude the call. If you have any further queries, please contact SGA, our investor relations advisor. Thank you everyone for joining us today on this earnings call. Thank you.
Thank you so much, everyone.
Thank you.
Thank you. Bye.
Thank you so much. On behalf of Nuvama Wealth Management Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.